Welcome back to macroeconomics class, and we'll be discussing on monetary policy. And as we look into this, we explore how central banks manage money supply, interest rates, and financial stability to achieve macroeconomic goals. And when we talk about monetary policy, what do we really mean? Monetary policy refers to actions by a country's central bank to manage money supply and interest rates, aiming for macroeconomics objectives like the price stability, full employment, and economic growth. And given a specific definition by Mexican, we look at monetary policy as the management of money supply and interest rates by central bank to influence aggregate demand and achieve macroeconomics objectives like controlling inflation, stabilizing the currency, and fostering economic growth. And it is calculated, policy-driven approach and to shaping the economic through the financial system. We have the key instruments that are being used in monetary policy by the central bank, and these are used to manage liquidity, influence credit, and guide economic activity. The first is the open market operation, and this is buying or selling of government securities to inject or absorb money from the economy. So the government try the central bank tries to buy or sell government securities to inject or to absorb money from the economy. And the next is the bank rate. And when we talk about the bank rate, it's also the discount rate. And this is the interest rate at which the central bank lends to the commercial bank. Also, another instrument is the cash reserve ratio, and this is the proportion of deposit bank must keep as cash with the central bank. And also we have the statutory liquidity ratio, and this is the percentage of assets that banks must maintain in liquid form like cash or gold. Another is the liquidity adjustment facility, and this is a tool used by the central bank to manage short-term liquidity fluctuation in the banking system through repurchase agreement known as repos and reverse repos. And the next is the moral suasion. When we talk about moral suasion, it refers to the informal method used by the central bank to influence the behavior of commercial banks without the use of direct regulatory measures. And lastly, the selective credit control as an instrument used by the central bank for monetary policy is it's selective credit control are qualitative tools aimed at regulating the distribution of credit to specific sectors or for particular purposes. And what are the goals of monetary policy? It actually aims to maintain economic stability and promote sustainable growth, though emphasis may vary. And these goals are price stability. Monetary policy helps in controlling, it aims to control inflation to protect purchasing power. Also, it aims to stimulate activity to reduce unemployment, also to lead to full employment. As per the economic growth, monetary policy aims to foster condition for investment and production. Also, as per the financial market stability, monetary policy helps to ensure or aims to ensure efficiency and confidence in the financial system. As per the exchange rate stability, the monetary policy aims to manage currency fluctuation in open economies. And as per the balance of payment, it aims to address imbalances in external accounts. We have another concept, which is the inflation targeting. When we talk about that, it is the monetary policy strategy, where the central bank publicly announces a specific inflation rate as its primary goal. And the core element of inflation targeting are the explicit target, which deals with the numerical inflation target, e.g., 2% of the CPI. Also, the central bank independence is another core element, which talks about freedom from political pressure in policy decision. Another is the forward looking, which talks about the proactive adjustment based on inflation forecast. And another is the transparency and accountability. That's 2 points, which is regular reports and communication to build credibility. These are the core elements in inflation targeting. What then are the benefits and limitations of inflation targeting? As per the benefits, it aids price stability. It also aids uh, predictability and reduced uncertainty. Also, it anchors expectation. It's used as anchoring expectation, and it helps to enhance credibility and accountability. As per the limitation or the criticism, it's criticized for neglect of other goals. Also, it's criticized for the rigidity in policy, its reliance on accurate forecasts, and also the difficulty with supply side inflation. And then countries like the UK, Canada, and New Zealand have adopted this framework, with emerging economies like Ghana and Nigeria also moving towards it. And what is the central bank independence is the ability of the central bank to make monetary policy decision without political interference. And the reason for ensuring central bank independence include um, maintaining price stability. So the need for central bank independence is aimed at ensuring that there is um, price stability, the maintenance of price stability, also prevention of politicized policy, also the building of investors' confidence. So this is another reason for ensuring central bank independence, to build investors' confidence. And lastly, for credibility and effectiveness. And these are the reasons why um, it's actually needed to ensure central bank independence from the government. And the central the ECB is highly independent, while the US Federal Reserve balances independence with accountability to Congresses. So that gives the difference between the two um, financial institution. And in conclusion, monetary policy is crucial for economic stability, inflation control, and growth. So central bank use various tools, just like we've discussed, in order to influence money supply and investment. And inflation targeting our cost expectation, while central banks independent ensure long-term credibility. Having the understanding of this mechanism is vital for analyzing how money, it's vital for how monetary policy shapes economic outcome. Thank you.